What's up, folks? It's June 2022 monthly market update. We're going to be going through a bunch of news articles impacting investors. Welcome, everybody. This is the monthly market update. Here we go. And if you guys have any questions or comments, feel free to type it into the chat below. We are giving away free ebooks of the Journey to Simple Passive Cash Flow. You guys can check this out at simplepassivecashflow.com/book, which you can also check out the audio book version of it there too. So we also put these monthly updates at simplepassivecashflow.com/investor letter if you want to kind of go back to the archives. I've been doing this for maybe several months now, but I'm always looking for more feedback for you guys. We also put this on the podcast, and if you guys are on the podcast, come back to the website and get access to these videos, because there's a lot of cool pictures and colors, and more importantly graphs and other graphics that I think you might be missing in just the audio format on the podcast. The first article here, Boeing to relocate headquarters to Arlington. And, they are moving away from Chicago. Chicago, nobody wants to live in Chicago anymore, Illinois, because it's kind of a state that's kind of going downhill really fast. But they are moving from Chicago to Arlington, Virginia. John Burns Consulting had this great article about creative land development. And here are some things to expect from land development this year. More build-to-rent projects in emerging submarkets. I think you're going to start to see this get kind of overheated at some point. You're starting to see preparing for higher density zoning as evident in a lot of zoning law changes in places like California, which is kind of the start of all this. A lot of single-family homes, predominant neighborhoods. We may make some room for more people. So they're kind of opening up the zoning. Stronger ties between master plans and environmental social governance initiatives, and provide more suburban walkability. Multi-housing news also reports that Middleburg kicks off construction of a Jacksonville single-family rental project. So this is just an example of a 250 unit development in Jacksonville, Florida, one of those kind of up-and-coming emerging markets. Arbor. So Arbor is one of the large direct Fannie Mae, Freddie Mac type of lenders, and this article kind of talked about affordability crisis deepens policies and market shifts in support of affordability. So, it's no secret that it's getting more and more expensive for people. Some will say that probably the affordability is getting to a point prior to 2008 recession levels, to the point where it's really hard for people to afford houses to live in. I frankly think that most people in America should be renters, but whatever I think, nobody cares about, I guess. But so Arbor there's this housing choice voucher program, which is receiving increased attention and funding. The proposed 2023 federal budget calls for a 17.4 increase in program allocations. This is all part of that Consolidation Appropriations Act of 2022. Warren says, aloha. Aloha, Warren. So states are increasingly adopting new measures to encourage the development of an affordable supply, including state income housing tax credits for developers or builders. And those are like, if you've never seen these things, there's all kinds of shapes and forms. Here in Hawaii, there's a myriad of different really radical ways they're doing it here in Hawaii. But on the mainland, predominantly, it's like a permit, or we'll go out and they might have some kind of good tax credits or lending credits for a builder, but the deal is, a certain amount of the units, say like 10% of units have to be reserved for, low income people at the low income rents. And take that backstory even further. At one point, I don't think this is in like the 1980s or 1990s, the government had this idea where they would just stick all the low income people all in one place and just have a bunch of housing projects. And of course, we all know that was kind of a failure, as it kind of was a seeding ground for a lot of crime and just really bad area. And they realized that they need to sprinkle low income folks all over the place to kind of spread it around. Of course, that clashes with the idea of not in my backyard. I don't want those people there, whether that's right or wrong or not. But that's kind of been the brought that to the forefront. But more and more, that's becoming that trend is going to be increasing. So if you live in a nice area, well, maybe you should live in an even nicer area because that stuff is going to be coming to your front door. One of If you guys want to Google and research this more, you guys can look up an acronym called LAHTC. I don't know exactly what it stands for. Each state or municipality, they call these things different things. Um, but that's kind of the one of the housing programs that they're talking about here. Fannie Mae also reports that economic growth forecast downgraded as a soft landing appears increasingly unlikely. So, they're citing expectations of aggressive monetary policy tightening through the remainder of this year and into 2023, aka rising interest rates, less free money, pumping up stocks for is basically what they're saying. And then, of course, the ongoing stemming of Russian invasion of Ukraine and the tightening of the supply chain. I'm actually just kidding there. I just threw in that supply chain because it sounded really cool, and it seems like everybody are using those three things in conjunction with each other, even though it doesn't really apply in some cases. But it's just I I make fun of it because I think at any point you can kind of say, well, here are two or three things that we're uncertain about in the future, and there's always going to be uncertainty. But that's why I say, well, and just invest in things that cash flow that have a good debt service coverage ratio up front, and then you don't really have to worry about a recession or anything really big happening, because if the storm comes, you just hold on and cash flow, keep calm, cash flow on, as we say. But we saw a bunch of the rents growing, and we're also now seeing the growth slow down, which does not mean that it's going backwards. It's just not going up at an astronomical 5, 6, 7, 8% per year pace anymore. Um, there's kind of a joke here. There's that the Bidens Build Back Better um, government stimulus plan, and there's kind of a swing set built next to a wall. The swings can't work on a wall, but this is kind of how the government does things. They puts money into the system, and I don't want to get political or anything like that. I'd rather we spend our time. Let's focus on ways where we can make money and where is the money going, not argue whether it's the right places or not. Here, HousingWire.com reports that Fannie Mae cuts origination projections, forecasts the recession in 2023. And, of course, a lot of news sources will always kind of make that prediction. But, not many people actually read the damn article, which we'll try and do a little bit of it here. Fannie Mae has lowered its mortgage origination forecast from 2022 and 2023 due to Federal Reserve's Fed inflation fighting monetary policy. Basically, their interest rates are going up. But I'll translate that mortgage origination forecast. So what they're saying is they're allocating, they're anticipating less mortgages being originated, which makes sense, right? Because I think you're already starting to see this happen across the country, at least in the really overheated areas where people aren't paying that crazy inflated price as they once did maybe a few months ago. Um, it's certainly to do with affordability, with interest rates going up and the borrowing capacity of homeowners going down. Going back to the article, Fannie's Economic and Strategic Research Group dropped its projection single-family mortgage origination volume for 2022 from 3 trillion to 2.8 trillion, which is like barely anything if you guys do the math at home. That's like, I mean, that's maybe like 5-7%. So it is a a change in the original projections. It also downside the 2023 forecast from 2.7 trillion to 2.4 trillion. It at one time compared 2021 where the total was 4.5 trillion. So it's around half of what it was in 2021. And this kind of makes sense. Um, Higher interest rates reduce borrowers' appetite for refinancing, which is expected to decline from 58% of the mix to 32% this year. So the refinances are definitely going down. And I think I saw another article around like this past year was like the biggest boom year if you were a mortgage lender on the money grab year, basically. So all that is kind of going away as there really isn't a good logical reason why you want to be refinancing for regular people, right? I'm just saying, at any point in time where you have equity, it's good to kind of tap that equity and do a refinance. But for the lay people, and that's what we mostly were talking about in these articles, it logically for them doesn't make sense to really do this refinancing activity, which is why volumes for the Fannie Mae product are down. According to Duncan, households with a 30-year fixed mortgage rate of 3% are unlikely to give that up in favor of a rate closer to 5%, a lock-in rate that will weigh on home sales. So that's exactly what we're talking about. But a sophisticated investor doesn't really give a rip about the difference between paying 3% versus 6% if they can get access to more money, if their property went up in those years. And that's the difference between a sophisticated investor and a lay investor. But the lay investors are the majority, and that's what drives the markets and these numbers. Multifamily net operating income growth across the country. So basically, this is kind of like cap rates in a way. I mean, the profits are going up, mostly because the rents are going up across states like Arizona, Florida, Texas, Georgia, and the Carolinas experienced a heavy influx of population growth during the pandemic. The NOI changes we have seen are not surprising, says Trepp.com. Back to some Arbor publications here. They're saying the top Q1 2022 small multifamily investment trends report says the economy shrank at a 1.4% seasonally adjusted rate in the first quarter of 2022. Still not really something that people should really freak out about. I mean, it was just growing at a crazy, crazy pace. And you can see this by the chart here. I mean, if you kind of drew a level line between 2020 and 2022, it just seems like your average general growth. But with that 2021, that was just a crazy year of crazy, maybe you could call that pent-up demand. It is technically a decrease in last year. Multifamily transaction activities surged in the last year. The refinances lending fell off. But prices are definitely going up, and especially in the last few months, pricing has just really skyrocketing, which is just and I think this is like where I see a lot of investors go wrong with this. They're like, well, let me just wait until it goes down. No different than buying a primary residence, I guess. Just wait, play the waiting game, or just play the game where I'm just making some semi-logical excuse not to do anything. Best time to buy was yesterday, especially if you're buying something for cash flow. With prices going up, cap rates come down is the result. Here's kind of a chart showing that. But as we all know, as I always say, I try and get people off of the interest rate idea, and it's more the spread between the cap rates between and the interest rates. You're seeing that spread pretty consistent here on this graph on the right side. Pretty much from 2010, it's been between 300 to 500 bips trading within that range. And that is the important thing for investors, because you take that's kind of essentially your profits, you multiply that by your leverage, and that's pretty much how you're making money as an investor, and in good times and bad times. And when interest rates go up and cap rates go down, that spread kind of remains pretty consistent. The one good thing in the economy, as you've seen, is like loan to value ratios are pretty healthy at this point, because people's equity positions have definitely gone up, and there is a lot of people with a lot of just pent up savings and liquidity. Um, wealthmanagement.com reports Blackstone pushes uh, sector strength. CRE push suggests the sector strength and then uncertainty. Um, they've been doing some new real estate acquisitions, and the $6 billion deal of a new portfolio of companies specializing in affordable housing. There's that word again. And then, according to Blackstone chief investment strategist, what does he know? Of course, right? I'm being sarcastic. These guys know. These guys are the smartest guys in the room. These Blackstone guys, which is why we follow them. It says a resilient and bullish housing sector is one reason the U.S. remains a safe bet for capital, while much of the world faces turbulent times due to the war in Ukraine. So EP5, this is the old thing that's kind of resurfacing as the program's getting restarted. As this is a means where as a foreign investor, they could put money into the United States to essentially kind of buy their way into the country. Some people didn't really like it. I mean, it was a good way of getting money into the country. It shut off um, September, or it shut off recently, but now it's kind of getting reauthorized through September 30th, 2027. Um, so some, for passive investors, I don't know if this is really a thing. I mean, to really be on the lookout for it. I do hear things like from other countries like China. It's harder if they don't want their residents' money to leave the country for obvious reasons. But maybe if anything, this is a great thing to show off to your friends over wine, to saying that something was that an EP5 project. But anyway, some of you guys care about that. Bloomberg Law reports that Blackstone to pay $505 million for Herbshaw Hospitality Hotels. Now, this is a 7 urban hotels, and this is their hospitality sector. So Blackstone they have so many different things they invest in. So, mostly, I don't want to say mostly, but a lot of it is in that hard asset real estate category, apartments, different types of commercial real estate, and they've got like their hotel side, and they've got all kinds of investments. Redfin News reports an influx of people moving into Phoenix, Tampa, and Atlanta. And there's a nice little graph here graphing the consumer price index percent change versus the Redfin net flow of user migration. So the cluster up at the top are Phoenix, Miami, Tampa, and Atlanta, Georgia. Also, Redfin is also saying migration hotspots in the Sun Belt are home to the nation's highest inflation rates. Phoenix prices of goods and services rose 10.9% year over year, first quarter on average, the highest inflation rate of the metros in this analysis. Next was Tampa, and then San Francisco, New York, Washington, D.C. followed the opposite trend, which tops. So those were their inflation rates were at 5.2%, the lowest in the country, roughly half that of Phoenix, Tampa, and Atlanta. New York was the second lowest inflation rate at 5.4%. Probably because we had a lot of people move out of San Francisco, New York, these city clusters during the pandemic, and we've been seeing people move back into those locations. But I think a lot of this is just this type of statistic takes a while to kind of play through and work its slack through the system. So we're still seeing a lot of that. But I mean, these three markets in particular, San Francisco, New York, Washington D.C., and they also say Los Angeles here. These are the perennial low cap markets where everybody wants to be in the foreseeable future. Nationwide prices were up 8.5% year over year, the highest rate in 40 years. And policymakers, including the Fed, consider a 2% an acceptable level of inflation. RealPage reports apartment renters renewing leases at record levels even as rents increase. So rents are increasing, but hey, you vote with their wallets, and they continue to stay and pay. So more than 57% of market rate renters with an expiring lease renewed over the last 12 months, up 3.5 percentage points. And this is in comparison to apartment retention between 2010 and 2019, where it averaged 51.5% before the COVID era, the post-COVID era, where things started to soar. And we're starting to see this trend of rent growth decoupling from apartment demand. And what this is a graph from ALN showing the civilian labor force and the participation rate. The size of the national labor force contracted in April, which you would think would be bad, but the development was the reason few people were employed in April and March, even as the employment rate remained at 3.6%. So, I mean, the way I look at it, it's this monthly fluctuations will happen. I think it's a little bit of just slack working its way through the system. But still, I mean, I try not to look at this stuff on the month-to-month basis or even on a quarterly basis, but I'm kind of forced to in these monthly reports with you guys. But I just still look at it more from an annual basis, and overall, like things are still just going up slowly. Not as it was in 2021, because I think there was a lot of pent up demand there, but just still slow going up. And most of the stuff that I'm reading is 2022 will kind of continue on this, but 2023 you might see some even more slowing growth, and some people are calling that a recession. I mean, yeah, I guess technically if you compare it to how amazing 2021 and the first half of 2022 was, I guess you could say in relative space, but I just not really seeing anything like really monumental happening. I think that might be the last right now, and then might be the last buying opportunity until things really skyrocket from there. Another graph here, through April and October of last year, monthly average effective rate growth for the US was above 1% for each month. After a slight cool down from November to February of this year, monthly average rent once again rose above 1% for both March and April. As previously mentioned, this renewed momentum in rent growth was despite a continued and increasing decline in apartment demand. So this part of this is just might be an inventory thing too, which is another factor in this. if units aren't being built or coming online, even if there's less demand for that month, you can still see the rents go up. Arbor had this article, housing market dynamics cause more renters to consider delaying home ownership. Factors is rising costs of home ownership, tighter mortgage underwriting standards, and shifting attitudes towards lifestyle renting. You know, that's a number two is kind of frustrating. I mean, like you have people who have really good jobs applying to get mortgages, and it's like they can't even get the money out and allocated, which is frustrating. But then again, it's I think that's what was the one stopgap put in there so that another 2008 wouldn't happen. But and I think that's really a big thing, and reason why I feel like things won't get ever like that again. It'll something be something else, I'm sure, but that government stopgap was put there so that no more ninja loans, no people that don't deserve loans anymore can get mortgages. Sure, the underwriting standards will always be kind of loosening up very slowly over time, but definitely you're not gonna. I don't think you're ever gonna see just a money grab for just ninja loans again, which is a good thing if you're somebody who likes there's very steadily growth. If you're somebody who likes crypto and likes things to go up and down, up and down, up down, and think volatility is how you can get rich, um, not good for you, I guess. CNBC reports that home affordability at the 2007 bubble levels, but the crash is unlikely. They're also quoting Blackstone's Joe Doge as their chief, I think, investment officer, pretty high up their guy. Um, he says, although that we're kind of back to those 2007 peak levels in terms of affordability, which is kind of a composite between home prices and where interest rates are, what people can afford. Most homeowners aren't using their homes like an ATM. If you're one of our investors, you sure as heck am, because that's how you don't get lazy and actually have your money work for you, so you don't have to work and trade time for money. But you're doing it in a prudent manner where you're looking at debt service coverage ratios. But again, this article is talking about most people. So he's continuing on. He's saying that caused so many people to go upside down. The firm's chief investment strategist told CNBC's Fast Money on Monday. The value of what they owed was greater than the value of their home. And that was the issue that happened in 2007, 2008, was that all these people got all these loans and were able to strip out all this equity, and then things kind of tipped over for some other reasons. Says historically, housing ends up being more highly correlated to labor markets than it is to mortgage rates. As long as the job markets remain relatively healthy, I think housing will be well. And I think what I like about these guys is they say something, but they put their money where their mouth is, and they go out and buy like like $500 million of apartments, or they just bought $505 million of hotels. And then he ends this book. The idea of having a national and prolonged drop in housing as the economy eventually rolls over, I think it's still a relatively low probability. John Burns comments on the apartment demand doubling in household boom. Renters leased 700,000 additional apartments last year, more than doubling the 5-year average. They also leased twice as many apartments in Q1 than in Q2 of last year. The three trends as pushing this forward is that a surge in household formation, more than double the nation's historical norm for apartment demand, record high occupancy. The 700,000 units leased so far exceeded more than 335,000 new units delivered, so new inventory coming online, but that just wasn't enough. We're still in a housing supply shortage. Occupancy reached 97.6% in the first quarter, the highest rate on record. So I'm not seeing any recession if you're a landlord in apartments. I'm not seeing that happen. If anything, recessions mean good things for investors, because And we'll change between investors who do the buy, hope, and pray, invest in their own primary residence or just some dinky rental property versus commercial grade type of investments. The people who are going to get hurt in a so-called recession um, are the people who are flipping houses or they're just going to lose a whole bunch of phantom money in their primary residence. So people who are cash flowing through this stuff are going to be people coming on top as the occupancy is very strong now and it'll probably be strong even through a recession. Where else are you going to put all these people? Rising incomes is another reason why household incomes rose 10% year over year, and this helped renters keep pace with the 14% average increasing in asking rents. Now that's the monthly report. Again, check out the family office Hana Mastermind. If you guys are tired of just going to the local real estate club or just interacting with people who you don't know personally, and you need to find more deals, what to do in syndications, the passive investor, what to do legal, tax. We've kind of created the epicenter of where passive investors to go. This number is a little old. I think we're above like 90 members to date. And all events going forward will kind of cater towards the family office group members. We're starting to move to a point where at one point we had a lot of events where we would say, yeah, come back again. But, for the most part, it's going to be catered towards family office members. So if you're not a part of that, we're not going to want really people loitering around events who just come and just never really opted to the more serious inner circle group in the future. But just some personal things, what I've been doing lately. I'm in EO, Entrepreneurs Organization, which is kind of a nice group, a nice change of pace from the kind of that. I'm not a big fan of like the real estate world mastermind groups because a lot of them, there's no verification on income. They just let anybody in. And it's kind of a fake it till you make it system. Whereas, EO, there are certain restrictions and verification processes on everybody. But it's nice to get around and not talk real estate for a change personally. And, one of the things we did was they brought in a Winhof instructor. So there I am on the bottom picture, filling my own grave with ice. And then, we'd chill out there. I think we were in there for like 2 minutes. 2 minutes. It was actually very hard. So that was like the hardest thing I've done this month, I think. In terms of contribution, now we're starting to have people read my damn book, and people are saying that they've been giving it to some of their friends and this is what I would suggest. I mean, if you have some people who are not as gung-ho about reading every single Simple Passive Cash Flow article or podcast, check out the book, simplepassivecashflow.com/book. I think it summarizes the whole 1, 2, 3 system that I kind of, in a roundabout way, created. And number one, invest in good deals where you don't get your money stolen by a bunch of shysters, where you do some value add. And then this allows you to get passive activity losses to bonus depreciation. And then you can implement a lot of the different tax strategies. Maybe you're able to do rep status, drive your AGI even lower. Well, that will help you save a lot of taxes. And then that allows you to invest more and maybe put it into an infinite banking policy, which is kind of third on the list of importance too. And if you're someone who's like $1 million net worth, or $1.5 million net worth, you save 50 grand a year. I mean, I don't see why you can't get financially free in like 5 years or less. To me, it's very simple. Warren asks, where can I get the book? You can Google it on Amazon. I would appreciate that. Always the reviews really help promote the book and get it out there to more people. But if you're a cheapskate and you just want to get it for free, I guess you can go to this webpage, simplepassivecashflow.com/book, and I have an audiobook version of there that you can get. But I don't know, if you guys have $1, help me out and buy the book. Because it kind of helps me. Like, I've been going through a life coach recently, and he's been what's your narrative, right? I mean, it's not all about making money, and it's for me. I kind of like this character of Robin Hood. There's to me, I see a lot of really hardworking people out there. I mean, I was once one. I mean, I still hardworking, but I really consider the hardworking people like who are working for somebody else, and there's really no passion behind really what they're doing. They're just doing it for a paycheck. Um, these are also the people paying the most taxes and propelling society forward, whether they're a doctor, engineer, lawyer, or accountant. Um, or maybe they're cooking up drugs as a pharmacist, a legal drug dealer. And these are the people that kind of need this stuff the most. Maybe you could just read my book and kind of learn how the wealthy do things, so you can get yourself out of the rat race. But I like this Robin Hood character because it's all about like a there's you want to see change in the world, and just go out and do it. And I think Robin Hood stole from the rich, give to the poor. I mean, maybe I'm like, well, yeah, don't you don't need to pay those taxes. There's these thing government incentives like investing in real estate that you can do to circumvent taxes. As far as uncertainty, because you need to have a little uncertainty in life. I mean, shifting in the markets with interest rates. Kind of taking a little break from some apartments lately because of rising interest rates, the war in Ukraine, and supply chain issues. Those are the three things that we're worried about now. I mean, if you bookmark this and watch it a year from now, it's probably something totally different. And that's where I kind of tell a lot of people, well, if you just invest for cash flow, you can chill out and not have to worry about these issues. I mean, yeah, the war in Ukraine is horrible, of course, but I'm just using it as an example of like these external stressors. I mean, if your money is working for you in hard assets, there is really very little to worry about. I do see slowing growth coming, but that still means things are growing, and I think that's exactly what the Fed wants. That things kind of keep growing. Thankful I'm not in stocks. I mean, I've seen it jump up and down. Like one day, like down 1,000 points, and then even worse is like the crypto stuff. I just don't understand it. I understand how you can create some kind of fake online following, get a whole bunch of influencers and venture capital people together and kind of do a rug pull. If you want to Google rug pull, that's essentially how a lot of these altcoins are created. Um, I I think that's a great way to make a lot of money. I don't want to do it because I don't think it's a good risk adjusted return. Or yeah, maybe it is. Maybe it is an extreme amount of return, so the risk adjusted return isn't that bad. But personally, that's just not what I'm for these days. I mean, I'd rather my money go to something that creates real value in society. How do I create a little certainty in my life? Well, I've got like a health coach now because apparently I can't control what I stick in my mouth and eat. So it's been cool. This guy like texts me and tells me encouraging things and keeps me accountable. So seems to be working these last couple of weeks. I guess more more updates if you guys hang out with us in our next retreat. I think we'll do something in Napa Valley in July. Um, but yeah. So in like May, I think this is May 1st. We did like a little wine event in Washington. It was nice to see a lot of the investors there, so that was kind of cool. Um, my my travels outside the house with a young child have been few and far between, but I do like them. Um, the important thing is just to do them and have it be a very curated event. I think is our plan for the team for the future. We're planning, of course, the retreat in January in Hawaii, and then maybe like I said, like that Napa Valley tour in July. But these are kind of the few and far between events that I think that we get the group together. Um, so be on the lookout for that. And if you guys want to get invites to that, you guys need to be part of the database. You can join at simplepassivecashflow.com/club. club, CLUB. But if that kind of brings us to the end, here's the legal disclaimer. I'm not a tax attorney, not giving any legal financial advice. I'm not a financial planner. I don't know why you want a financial planner. They just are just licensed salesmen who sells you a bunch of like Wall Street investments. But that's just the world that we live in. But thanks for joining, folks. Again, I put all these monthly updates at simplepassivecashflow.com/investor. And we'll see you guys next time. Bye.